three statement relationships. So there are four combinations where profit and cash flow differs. So this is where every difficulty of accounting occurs. And this is where, students who first study accounting finds accounting difficult. So four combinations. First of all, combinations that in terms of revenue, there could be cases where we can record a transaction as revenue, but the cash has not been yet collected. So things like accounts receivables and so on. So we're going to see the cases as well. There could also be a case where we have already collected cash, but in terms of accrual basis accounting, we cannot recognize the transaction as revenue. On the other hand, expenses as well, same goes here as well. So in this case, so where we recognize revenue but we haven't collected cash yet, items such as accounts receivables or accrued revenue occurs. And since these two items, we can say that it is something that carries future economic benefits, right? These two items, we're going to collect cash in the future. So these have future economic benefits, and it is also controlled by the company. So they should be classified as assets. On the other hand, if we had a cash inflow, but we haven't recognized yet as revenue, these are items such as unearned revenue or deferred revenue. In this case, we have already collected cash, but we haven't yet, done our obligations for the client or the customer yet. So in this case, we have a future liability. So unearned revenue and deferred revenue, these kind of items are classified as a liability. Items like depreciation, amortization, pension liabilities, or bad debt expenses. For example, depreciation, in the income statement, we classify it as an expense, but these are expenses that have not yet, generated cash outflows. So in this case, liabilities should be created or assets can be decreased. So we're going to look at it, look on the details a little bit later. But anyways, in the case for depreciation and amortization, it does not create a liability, but it rather decreases asset accounts. But for pension liabilities, for example, many companies, they provide pension. So when you retire or when you quit your job, usually the employee receives a huge chunk of money. Those kind of pension liabilities are accumulated each month with the payroll. So for the pension liabilities, usually there's not a cash outflow until you retire or quit, but rather in the income statement, it is constantly recorded as an expense. So in that case, the company, they record it as an expense, but they haven't yet paid out cash. So in this case, the company carries future liabilities for the employees. So in this case, a liability is created. Lastly, things like, for example, things like prepaid expenses, capital expenditures, R&D capitalization, or inventory purchase. If you have, if we built a big factory, let's say Tesla has built a big gigafactory in China, a huge outflow of cash obviously have occurred. So there has been a huge outflow of cash, but the transaction is not immediately recorded as an expense. So in that case, the company has now future economic benefits from that transaction. So an asset is created, and usually things like property, plant, and equipment, intangible assets, inventory, or prepaid expenses, these kind of accounts are created on the asset side of the balance sheet. So the four combinations, and the key here is to identify whether this creates a future obligation or whether this creates future economic benefits, and we classify it as an asset or a liability or a contra asset. And another key here is that these kind of transactions at the end, at some point of time of the corporate's life cycle, are going to be reversed. So these kind of effects are temporary differences, and at some point of time they're going to be reversed. And when they're reversed, we're going to do the exact opposite of what we did on the first transaction. So let's move on. Let's see how the three statements are related, and let's see how the three statements go in each of these four combinations, in each of these four cases.